From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. A strong, robust jobs report. Not enough to knock the rates market off its decision. 25 basis points for June. Cuts locked and loaded. We're counting down to the market open. It's robust this Friday morning.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, futures rise, yields fall. The markets digest the latest payrolls report. Chairman Powell suggests the Fed is moving closer to cutting rates. And President Biden takes aim at Donald Trump directly in the State of the Union address. We got that. It is Payrolls Friday. We get the immediate reaction from the White House. That is momentarily. Anne-Marie Hordern is standing by. She's ready to speak to the acting Labour Secretary, Julie Su. I want to give you a quick snapshot of how risk looks at the moment. 275,000 are the headline number on the non-farm payrolls, certainly comfortably beating the estimates out there. We have a Chair Powell who is not far from having the confidence needed to cut rates. Does this stronger jobs report with its revisions embolden that confidence or challenge that confidence? We will debate that over the rest of this hour. Abnormal times, abnormal gains, and the ferocity of the 25% run-up in equities over the past 5 months has only happened 10 times since the 1930s, according to Bank of America and Hartnett in his report. I would just say to you this: NASDAQ up 0.25%. However, there are outflows from tech, the largest weekly outflows on record from tech. Who's ripping the money out of tech? $4.4 billion went out of technology. Is that enough to unseat you? Is this a retail rally, or is this an institutional underpin rally? Look at the Russell go. We've now locked and loaded 25 basis point cuts by June from the Federal Reserve, and that is what gives succor to the breath, 1 1/8. We're going to get straight across to Anne-Marie Hordern. She's standing by for a very important conversation from Washington, D.C. Anne-Marie Hordern, good morning.
Thank you so much, Manus. And on this Jobs Day, we want to bring you an interview right now with Acting Labor Secretary Julie Su, who joins me now. Secretary, thank you so much for your time. So we just got the data, have been digesting over the past 30 minutes. The jobs number came in higher than expected at 275,000 jobs, but the unemployment rate ticked higher to 3.9%. Can you explain that divergence to us?
That's right. So the jobs numbers continue to be very strong. The 3-month average is actually 265,000. So, we look at trends as much as we look at monthly numbers. And on that, the unemployment rate remains under 4% for over 2 years now. That's the longest stretch in 50 years. So as the president noted yesterday, last night, the economy remains strong. The union remains strong. We're moving things in the right direction, and we have more work to do, and we'll continue to do it.
Right, but we've had revisions as well, and that's going to be tempering some of this hot labor market. So revisions were down for January by 124,000 jobs. So is this job market not as strong as you were expecting and anticipating?
No, I mean, the job market is stronger than anyone really predicted. Let's go back to, when the president first came into office and all predictions were of, recession and crisis and crash. None of that has materialized. That doesn't happen by accident. It happens through leadership and strong economic policies. And, we're seeing that month over month. The revisions are a feature of the numbers. We put out numbers every month so that we can have a picture that tells us what's going on in the economy. And then we revise them to make sure that they're accurate. And that's why we look at, again, not just what happens each month, but over time. And our over time figures demonstrate strong, steady, continued growth. Exactly what we want to see. It feels like the very definition of a soft landing.
Well, when you look at the manufacturing space, this report, we have manufacturing jobs coming in at negative 4,000, computer electronics and manufacturing coming in at negative 1,700, and semiconductors negative 700. President Biden last night was touting manufacturing jobs. But when you look at the manufacturing space, when he last spoke at the State of the Union, he's only added about 70,000 in that manufacturing space. Do you think this shift towards more manufacturing in the United States is starting to stall?
No, I don't think it's stalling at all. I think it's just taking off. So many of the investments that the president helped to get across the line with Democrats in Congress are really just coming to fruition now, right? They're gonna hit the ground in 2024.
But then, how do you explain the negative read on manufacturing jobs in this report?
Well, again, overall, the manufacturing jobs are up. It's up over 700,000 since the president came into office. And he has been very clear that there's no reason why we can't make things in America, right? We invented semiconductors here. We're going to make them here. And so those factories have to be built. Those jobs, are still to come. But his vision for an America in which we can build things here, resilient, make our supply chain more resilient and create good jobs, including good union jobs in all communities. That is what the monthly numbers show. It's definitely what the overall trends show.
When you look at where jobs were created, it's coming from the federal government, 9,000, state jobs, 5,000, local, 38,000. Actually, we haven't seen a drop in government payrolls on a monthly report since August of 2022. Do you think the expansion of government is partly responsible for keeping this labor market where it is?
Well, so the job growth numbers are really much more broadly, it represents much broader industry change than that. We saw big changes in healthcare, right? Hospital jobs were high. We saw an uptick in transportation and warehousing, in social assistance, in restaurants and bars. So it is a story both of private sector growth and of government growth. Even if you take the government out, the total growth is of over 200,000 this month just in the private sector jobs alone. So it is broad-based recovery, which is, again, further sign of its strength. It isn't just one industry that's been driving this.
Well, we also saw in this report wage growth was cooler than expected. That's when it came in. And obviously, we do know that even though there are some gains in the labor market, inflation continues to dog American consumers. This is something that Americans continue to say, that this is something that continues to eat into their household gains, their discretionary spending. How concerned are you about this cooling of wage growth?
So this is work that continues, right? Controlling for prices. Again, inflation has been cut by some like 2/3, and we want Americans to, be able to obviously get some of that breathing room the president talks about. Now, some of that is about making sure that real wages are going up. More wages in workers' pockets is always going to be a good thing. And so, again, the average overall annual wage increase is still it's a little over 4%. It exceeds inflation, which means that we can both have lower prices so that Americans feel less stressed about what they have to pay for basic things, but also higher wages, which is about, making sure that people can have family-sustaining jobs. And those two things go hand in hand, and they certainly go hand in hand under President Biden's economic agenda. And we are, again, seeing all of those trends in that direction. Doesn't mean we don't have more work to do. We do, but we're going to stay at it.
So you think this cooling was potentially just a monthly blip?
Well, I don't know. I wouldn't call it cooling. I think that, again, you look at overall the numbers, 275,000 jobs created. Unemployment rate remains at under 4%. We are continuing to see real wage growth. Now, the inflation numbers for this month have not come out yet, but all of those paint a picture of an economy that has recovered from the depths of the pandemic, in which almost 15 million jobs created since the president came into office. And I think, it's really just a good news story all around. And the historic investments that the president has made possible, right? He has a vision for this country. It's not going to be built overnight, but we've certainly seen gains over the last 3 years, and we'll continue to see them as the policies that we've put into place really start to come to fruition. That's, it's a story of continuing improvement and progress and meeting the challenges across the country.
I just want to ask you about something that happened at the U.S. Bureau of Labor Statistics. An email that was sent out to quote-unquote super users about a measure of rental inflation was a mistake, according to the Bureau. Why are some people getting emails about inflation and others are not?
So we put out these numbers broadly. There's no reason not to share them, and I'm here to talk about them for that reason too. If I know what you're talking about, I think there was a response to certain questions that have been asked, but we certainly don't have a pool of super users who get this information that other people do not. Our entire purpose here is to tell the story of the labor market, tell the story of the American economy, and especially when it's such a good story, we have no reason not to share it as broadly as we can.
But do you think this raises any questions of transparency?
No, and we certainly would not want it. Our goal is to be transparent. Again, we collect this information for no other reason than so that we can understand what is happening in American households, what the job situation is, what jobs are being created. These Bureau of Labor Statistics numbers drive economic policy for a reason, right? They're strong, reliable. It's the broadest survey that exists, and again, we want. We work for transparency. We want people to know what is going on in the economy, and we think it's important.
Acting Labor Secretary Julie Su, thank you so much for joining us, especially earlier today. The administration, Manus, has changed actually the time when data comes out and they come out and speak on it. Now it's only a 30-minute gap. You know, what I was so surprised about, the Acting Labor Secretary there talking about manufacturing in the U.S. just taking off. But the data this month actually showed the weakness in the jobs report was in the manufacturing base. Yeah,
she did push back. She pushed that narrative in terms of the total jobs created since President Biden came into office, with the manufacturing up 700,000, as you say. But Anne-Marie, great work there pushing back with the data. Anne-Marie Hordern in Washington. Coming up, jobs data, a little bit hot.
The market, however, will interpret this as good news. So you're going to have even a bigger separation between economists who tell you things are uncertain and the market who sees things as all positive.
We're going to catch up with BlackRock's Rick Reeder next on the data, right here on Bloomberg.
If you think that the labor market is too hot, you will point to the beat on the markets. You will point to the increase in hours worked. If you think that this labor market is just right or softening, you will point to the revisions and you will point to hourly earnings. The bottom line for policymakers and for most economists, we will see this as not containing much new information. The market, however, will interpret this as good news. So you're going to have even a bigger separation between economists who tell you things are uncertain and the market who sees things as all positive.
How hot is this jobs data? That is the question, blowing past expectations, bolstering the strong government hiring in the month of February. Joining us now is Mike McKee. Mike, we're drilling into the numbers here. It looks like the market's focused on the wages component.
Wages component, probably the most important thing for the Fed here. The 275,000 jobs created is much better than what we got in revisions for the month of January. But remember, January was 353. So we've seen slightly lower labor progress during the month. But they're going to look at these, the fact that the unemployment rate went up to 3.9% and wages only went up 0.1%, and think that they are making progress on inflation, even with strong job creation. And the job creation was fairly strong. You take a look at what we had before the pandemic and what we have now, and you can see that it's moved up. We have much more strength on a month-to-month basis than we were seeing before the pandemic hit. And it does suggest that at this point, we are able to have strong growth without a lot of inflation. Where was the growth and where wasn't it? Well, in this report, it's kind of more interesting to look at where it wasn't. Manufacturing was down 4,000. You heard Anne-Marie talking with Julie Su about that. Temporary help, which is sometimes seen as a harbinger of the future, down by 15,000. Food and drinking places up by almost 42,000 after a couple of months of declines. And healthcare, which is always the big contributor in this economy, 90,700 additional jobs. Now, the average hourly earnings number is important because the Fed thinks that at this point, the wages people are getting, the raises people are getting, are too much for inflation. They think we should be seeing between 3 and 3.5% on a monthly basis. We're still seeing 4.3%, but after a jump in January, it has moved back down. And when we look at the numbers under the numbers, the service industry payrolls were up only 0.1%, even though that's where 204,000 of the jobs were created. So at this point, it looks like good news, and it's one reason I think that we're pricing in rate cuts again.
Okay, Mike, thank you so much. On the back of this payrolls report, let's get to Rick Reeder, waiting in the wings, BlackRock's Chief Investment Officer for Global Fixed Income. Rick, good to see you. So,
you too.
Having a conversation with a couple of people on the IB at the moment, and they say, look, this is a great report for the Fed. We're pricing in 4 rate cuts. June is locked live at 25 basis points. The wages aren't hot. This is a good and confidence building to cuts for the Fed. Good morning.
Good morning. I think that's a fair assessment. Listen, I think you got to take the Fed at its word that 3 cuts is probably the likely place. But, you know, there's some asymmetry to it in that because of geopolitical and other reasons, can you lean a little bit into closer to 4 cuts? I think so. So, yeah, I think it was good. I mean, there were a couple of things I think that Mike described that were important. One, you know, you're starting to see, I look at temporary hiring. I look at professional business services a bit softer than it's been. You know, by the way, it follows on the quits rate this week that from the JOLTS report, that was a bit softer. So, yeah, I think it's, Fed was looking for some more good news, to quote Chair Powell, and I think this generally gets you there.
What about the other side of the trade? Because, of course, you've got Kashkari mooting maybe 1 cut and done, and then we pause. Bostic talks up the idea of being 1 and done, and Kashkari talks about the risk of maybe moving his dots. Strong data on the headline versus the wages number. Do you think, Rick, it emboldens this slightly more hawkish view that has been building, which is directly opposite, I would say, to what Powell gave us at Capitol Hill over the past 2 days?
So I'd say a couple of things. The economy is moderating. It's still a solid economy, but it's moderating. You know, you look at the data today, you look at, by the way, we spent a lot of time on corporate numbers. You look at corporate revenues. You know, it's a little bit disappointing. The earnings were good, but revenue's a little bit disappointing. And their forward projections, I'd say, particularly in the cyclical spaces, suggesting some slowing. So let's take that and say, okay, so let's say we're moderately slowing. Good economy, though. Inflation is moderating. You know, we think core PCE is going to be at around 2.5. You've got a funds rate that's 5 3/8. If you said, okay, I got 2.5 inflation, you got a 5 3/8 funds rate, you're very restrictive. If you cut rates 75 basis points, you're arguably still restrictive. So, listen, I think the economy's in good shape, but I think the Fed is too restrictive to what we think the inflation level is today, and they can get it closer to the levels. You don't have to get to what would be a fully neutral level, but I think almost definitionally, you have to move that rate down from where it is today.
Okay, so you're in that let's get these rate cuts started, let's get the party started, which then takes me to the view, have I just missed the last bullet train on picking up duration at the 10-year level, or will I get another opportunity, as it were, to get a higher yield? Do you think you should step in now on sovereigns in the first instance? I'll come to credit in a moment.
So, by the way, I'm going to throw out one last thing that I didn't say before.
Sure.
One of the things when you keep interest rates high, you're seeing this, that it becomes a tax on lower income, on the local banking system, real estate. And you're seeing things, and we continue to see it in some of the retailer data. You see it in some of the credit card delinquency data that suggests that, meaning get that rate down a little bit and it helps the broader population. Okay, so now your question about have we missed the run in rates? We've had a pretty good couple of weeks here in the rates move. Listen, I don't think duration, I don't think interest rate exposure is going to get away from us. You know, you're still, the 10-year, and I've argued this, I think last time we were talking, 10-year at 4 to 4.25. That's, if you assume, we talked about last time, if you assume inflation 2.5, you put a real rate on it and you say, gosh, nominal GDP is going to, run at about 4.5 this year. 10 years not. I think as you get in the second half of the year, you'll start to see the 10-year get down to 3.5 to 4, but, not that big a move from where we are today. I think the front end could move. And I think part of why I think income is so interesting today, you can buy income in the front to the middle part of the yield curve. That's pretty interesting because I do think that'll move as the Fed starts moving.
I mean, there is the very short end of the curve. We're just showing it there, twos down, and that is where the real reaction function is. Rick, we've come to the close of business on Friday, or we're nearly there. It's a frenzy. Gold record high, Bitcoin record high, SPOOs record high. I mean, look, I've been through so many of these frenzies, it makes me nervous. But then I look at corporate credit. I know, call me old-fashioned. Corporate, riskiest triple C, Rick, it's delivering nearly 7% return. It's trumping pretty much everything else out there. Does that look seriously overpriced?
So there's a couple. I mean, it's a great question because there are a couple of things going on. If spreads in credit are pretty full, are they interesting? They're okay. The reason why, quite frankly, I actually like buying credit. Triple C's, different trade. Would I say, gosh, we should own some triple C's? I'd rather own equities because I don't think the multiple in equities is that onerous for particularly in some of the growth areas of the market. But if you said to me today, gosh, I can book yields today, and if you create a portfolio of quality income and credit, use some securitized assets, maybe a bit of EM, if you can create a portfolio that gets you 6.5% to 7% yield with a stable interest rate environment, boy, that's a pretty good portfolio. By the way, the reason why you're getting it is because service level inflation is too high, Fed keeps rate high, and corporate borrowers are arguably in the best shape they've ever been from a credit quality point of view. And so you're getting to buy these yields at super attractive levels relative to history. But your point about the spread to treasuries, not that interesting. I just think this year you'll be happy having clipped a lot of income and let it work for you.
Well, just have a look at that. We'll leave you with that thought, Rick. The 2s, 10s just spiking higher there. So definitely a repositioning on this curve as we see the short end trading lower. Rick, great to get you with us this morning straight after the jobs report. Rick Reader there of BlackRock. Coming up on the show, morning calls. Rick would prefer a little bit of equity in the portfolio as well. More on the latest payrolls report. We've got PGIM's Michael Collins with me. iCapital's Anastasia Amoroso. That conversation still ahead on the opening bell. On what the analysts are saying on Wall Street. First up, JP Morgan upgrades General Electric to overweight, pointing to the company's strengthening aerospace division. Next up, RBC Capital upgrades Carvana to sector perform with a street high at $90 a target, highlighting the company's underappreciated cash generation. And finally, Morgan Stanley upgrades UBS to overweight, expecting a strong comeback for the investment banking arm of the business. The stock trades at the highest level since 2008. Coming up, we've got PGIM's Michael Collins. We've got iCapital's Anastasia Amoroso joining me after the opening bell, discussing market implications. Stocks holding on to the green. 4 is the magic number. That is what the market has priced in for rate cuts 2024. The Fed is in an awesome place. Not my words, but those of State Street. There you go. Irony, State Street Global Advisors. Tim Graff on the IB with me. We're in an awesome place in terms of the propensity for the Fed to cut rates because the wages are low. Great for volatility. Held volatility. There is the opening bell. She strikes it out at green in the opening calls. The Russell is up by 0.8%. That is the broadening out trade. Euro flat 109.56. 10-year yield dips ever so slightly. It is the short end of the curve where you're seeing the real movement to the downside as the momentum is. This is enough to let the Fed continue with the trajectory. Is it the confidence that Powell needs to cut? Some people in the market says it delivers an surety for June, which is what Lagarde intimated along with Powell. Crude down by 0.4%. There's one stock to open at watch at the open. It is Costco, the big box retailer, posting weaker than estimated second quarter results. The margins also falling short of expectations. Abigail Doolittle is with me on the Costco trail.
This is an interesting one, Manus, because the quarter itself was actually really pretty strong. The stock, though, is down 4.2%, as you can see. That's the worst day going back all the way to 2022, December 2022. Let's start off on the good and then move to the bad. So relative to the quarter that was, adjusted earnings of nearly $4 per share, beat estimates by 8%. Sales, though, there was a little bit of a miss there, $58.4 billion. This, even as same-store sales remain solid, as consumers apparently are still seeking value. The in-store traffic was really the driver as opposed to larger transaction tickets. That said, their e-commerce platform is picking up in part because of their digital app, and that is helping to at least drive an improvement for the big ticket item. So overall, the quarter there was not so bad. But in terms of what could be driving the stock down, Citi is saying that there's a lack of catalyst for the stock. Yesterday was at an all-time high, if you can believe it, up a whopping 62% over the last year. Baird is saying, commenting on that price action, saying that valuation is at a near an all-time high. And then we have some analysts saying that it's just not a good thing that they haven't raised their membership fee. Whatever the factor is, I think that it could be that massive rally into this, a good quarter, but maybe not the perfection, to your point, Manus, that some folks wanted.
Okay, Abby, thank you very much. Keeping an eye on those retail stocks. It's been a big week. Let's stick with the earnings front. Pivot over to Broadcom. The shares in the red despite increasing demand for its AI products. Investors are focusing on the company's chip sales instead, which fell short of the estimates, and that's the disappointing part of this report. Ed, what have we got this morning? Down 1 1/4.
Yeah. It's a real mixed bag. I mean, Broadcom did make an attempt to open higher this Friday. You can see that we're down almost a percentage point in the moment. The story is really simple, which is that there is an AI-relevant part of Broadcom's business, and they've upped the proportion of sales to 35% this year, where they see growth coming from AI. But the reality is that it's bread and butter business, which is providing semiconductors for smartphones. They never name this customer, but Apple is their biggest one in North America. It's just not performing as expected. There is softness there. So in the fiscal first quarter, sales of $7.4 billion, below street expectations of $7.7 billion. But they were able to kind of reaffirm this full year fiscal 24 target of $50 billion of revenue. So it's a bit of a mixed picture. The after hours declines were more significant than you're seeing on your screen following the open. Where Broadcom is AI relevant, it does not make AI accelerators or GPUs like NVIDIA does, but it does make the networking gear that goes into the build out of a data center. So if all of this infrastructure spend is happening, then it's likely that there will be some feel good for Broadcom. And indeed, they said the contribution of AI will be 35% this year, up from 25% their previous forecast. But they're also in the custom silicon business. And if you think about the hyperscalers, those operators of data centers that are powering the training of large language models and now moving to the inference side, a lot of them are using custom silicon, the most obvious example being Google and the TPU. There could be some benefit for that if customers come to Broadcom and say, make us our own custom AI chips. The stock down 1.2%. Happy Friday.
Happy Friday, Ed. Thank you very much. Have a good one, Ed Ludlow. Let's get back to retail earnings. We've got Gap topping out the estimates for the fourth quarter, a sign that the recent turnaround efforts are beginning to bear fruit. How big a fruit bowl is it? Isabel Lee's with me.
Hey, man, it's quite big because reports are actually positive. We have Gap shares surging around 8%. Gap reported fourth quarter EPS that beat expectations. And Barclays called this report encouraging. Shares are up. Now it pared back some of its gains. It's up around 4%, but still in positive territory. So we have Gap reporting an EPS at 49 cents. That's more than double the estimated 23 cents. Revenue also came in higher at $4.3 billion compared to the $4.2 billion estimate. So Gap is a big umbrella brand. Under it is its namesake, Gap, Old Navy, Banana Republic, and Athleta. And for a while, all the brands are really struggling. But we have Old Navy and Gap seeing signs of progress, and that's why analysts are a bit more bullish. Unfortunately, Banana Republic and Athleta are still dragging down their sales and profits. But still, Jefferies calls this as the early innings of a recovery story, and Barclays says this is textbook retail recovery. So Barclays even raised its price target, as did Jefferies and as did Telsey. So Gap has been trying to really rebrand and revitalize its image. It hired a new CEO who's been in the position for a little over 6 months. We have Richard Dixon, and he's been trying to make waves. So for instance, he hired Zach Posen to really kind of make his mark in the fashion world into the brand. And maybe it's working because ever since he took the role, Gap shares has roughly doubled since in value. And for the full year, though, it's not looking so positive because Gap expects sales to be roughly flat from the previous 12 months, citing uncertain macroeconomic environment. But today is a good day for Gap, with shares still up, Manus.
Okay, Isabel, thank you very much. And another stock having a rough Friday. It's Eli Lilly. The company's Alzheimer's disease drug faces further delays in getting approval due to concerns over the drug's safety. What are those concerns? Alex Semenova joins me now. Alex.
Hey, Manus. Well, yet another regulatory blow to Eli Lilly's highly anticipated Alzheimer's drug. The experimental medication donanemab will be delayed past the end of March. This is as the U.S. FDA plans to call a last-minute meeting to review the safety and efficacy of the drug. This decision comes just weeks before the FDA was expected to rule approval on the drug. The agency said that it wants to hear from outside experts on the safety and effectiveness of it. This sent shares down as much as 2% in pre-market trading. They're down more than 1% here into the open. Eli Lilly was still up 34% year to date as of yesterday's close. That's thanks, of course, to the success of its obesity medication. And as such, analysts weren't too worried about this delay this morning. BMO said that despite the fact that this was a surprise, its broader thesis is still intact, with obesity medications being the core driver here. And analysts at Barclays said that donanemab is increasingly peripheral to the stock's narrative. Lilly said that there was no change to its 2024 fiscal forecast. Manus?
Alex, thank you very much. Alex Semenova there. Let's get a little bit more on this jobs report today. We're joined now by iCapital's Anastasia Amoroso and PGIM's Michael Collins. Looking at the two-year yield, this is what we're showing our viewers this morning, 445. We are down. This is the very short end of the curve, trading with a lot more assurity. Michael, Anastasia, good morning to you both. Mohammed El-Arian says this is an ambiguous report. Tim Graff from State Street is on the IB with me right now saying this is an awesome position for the Fed to be in because the wages are lighter than we estimated. The revisions help us. Michael, is the Fed in an awesome place to have the confidence to cut as soon as June? Good morning.
Good morning, Manus. You know, people love to criticize the Fed, but wow, you know, it's hard to look for fault in their behavior really through this cycle. They were a little slow to start raising rates. They'll probably be a little slow to start cutting rates. That's their typical MO, right? They kind of sit on their hands and they wait for a reason to cut rates. And they really haven't had that reason. The economy's doing fine. The labor market's doing fine. But inflation is moderating. Wage gains, you know, are all the way down to the 4s, and they were close to 6%, you know, year over year, just a couple of years ago. So everything's kind of moving in the right direction. The economy is stabilizing, moderating. Inflation is coming down slowly. I mean, it's really, the soft landing is fully priced in, and maybe justifiably so. So the Fed can be patient, they can wait, but remember, the risk of the policy mistake is not that they cut too early. I think it's that they wait too long to cut and cut too slowly. But so far, so good.
Well, let's take this over to Anastasia. Good morning to you. The risk is that, as Michael says, is that they wait just too long. And I had Citi here this morning saying they're still seeing the risk of a recession. But I take you back to 1995. It was a bull run. It delivered 28% return over the next 6 years through to March 2000 before the bubble burst. Anastasia, the effusiveness with which we describe these equity markets every day. I mean, NVIDIA is in a land of its own. But the bullishness in these markets, you know, is it beginning to look like something that has the hallmarks of a bubble?
Right, Manus. Well, on the surface, you would think it does, given just the rip-roaring rally that we had. But it's interesting. I was looking at the technical indicators for the market today, and specifically the relative strength indicator, and we have been near an overbought condition of 70 for about since the middle of December now. And so typically, you know, that overbought condition doesn't really last that long. Something happens to derail that, and you have a pullback. But we haven't had this time around. And when I sit back and think about why that may be, because I actually think the backdrop for the markets is just in such a sweet spot right now. Because on the one hand, if we have faster economic growth, if we have this growth reacceleration, which is clearly playing out, that's good for companies. That's good for revenues. It's good for earnings. It's good for margins. And that's why we've actually seen the earnings estimates for the S&P 500 firm up for this year and next. So that's great. And that negates some of the expectations that, well, we need the Fed to cut rates, because if we have solid economic growth, that offsets a lot of that. And then on the other hand, you know, if we do hit a little bit of a slower patch, then the Fed does have the ability to cut rates given where inflation is. And if they do cut, that would support the economy and that would support the valuations as well. So I think that's why we're not in a bubble, where we're just in this really nice spot in the markets right now, given those two conditions.
And I think you sum it up very nicely. You say we're in this sweet spot. Michael, you say we're in a 1994 to 1997 paradigm redux. For anybody that wants to tune in, there were moments of cutting and then pausing. There were moments of crisis in LTCM. There were various things that forced policy response in the 1990s. But the hallmark of that was cut and serious pause periods. And again, I would say to you is that we've had that narrative from the likes of Bostic, et cetera, coming out with it, and Waller, talking about 1995. So the market says 4 cuts. The building narrative within the Fed is that we're up for pause and maybe even 1 cut. Again, markets and the Fed are divorcing. We're spread. The spread is widening again, isn't it?
You know, it's not widening enough to really make a difference, Manus. I think if there's a mispricing, it's that, you know, the markets are only pricing in the funds rate going to 3.5, really, and getting stuck there for 10 years. And as Anastasia said, you know, the Fed has a lot of dry powder. But to your point, you know, everybody's anchor, man, is to assume when the Fed raises rates 500 basis points, you know, things come crashing down. But this cycle is different. It's probably akin to the mid-90s, and we do use that as a similarity because, you know, right after the kind of S&L crisis, you know, balance sheets kind of got cleaned up, and we had the GFC, we have a tighter regulatory environment. We just came through this brutal pandemic. We haven't had the time to kind of over-lever the system again. The private sector, including the financial sector, the housing sector, some of the big cyclical sectors like commodities and autos and housing and home builders are delevered, right? So you don't have this kind of house of cards that normally builds up through the cycle, and then the Fed, you know, smashes it down with their rate hiking hammer. So the private sector is actually in really good shape. So yeah, we're thinking the Fed can orchestrate this soft landing, but they do have to cut. 5.5 is too high of a funds rate when the inflation is about half of that, right? So we've just entered the period for the first time this cycle where the real funds rate is significantly positive, right? So that's really what can start to bite over the next year if they don't move. But again, you know, I think the soft landing camp is really the way to go here.
Okay, well, we've got 2 full bullish narrative there. Yeah, you're right in terms of the real rates. Michael, Anastasia, stay with me. A little bit more work to do. Coming up, President Biden makes his pitch at the State of the Union.
My purpose tonight is to wake up the Congress and alert the American people that this is no ordinary moment either.
The latest from Capitol Hill, The Conversation on Bloomberg.
My purpose tonight is to wake up the Congress and alert the American people that this is no ordinary moment either. Not since President Lincoln and the Civil War have freedom and democracy been under assault at home as they are today. Now my predecessor, a former Republican president, tells Putin, quote, do whatever the hell you want. I think it's outrageous, it's dangerous, and it's unacceptable. I know it may not look like it, but I've been around a while. When you get to be my age, certain things become clearer than ever.
President Biden jump-starting the 2024 presidential race last night at the State of the Union address, taking aim at Donald Trump and the Republican Party members over an array of issues, including foreign policy, immigration and the economy, and reproductive rights. An energized Biden also looked to quell the concerns over his age and mental fitness. Amri Hordern had a busy and long day yesterday. Amri, what do you think the outstanding part of that State of the Union was? What did he grip?
I think it was this one moment, and Biden has actually said this before, but he reiterated and saved it for the very end of the speech, Manus, when he said, it is not how old you are, it is how old are your ideas. In that one line, which is going to be a pivotal line he's going to take to November, he did 2 things. One, he addressed his age concerns, but he also wanted to put a different path forward than the former President Donald Trump, who overshadowed this entire speech. You know, let's be clear. This was a political speech. Many analysts I'm talking to say it was very partisan, and it was a campaign speech. He didn't mention former President Donald Trump by name, who's going to be his rival in November, but he kept saying his predecessor. And with a number of issues right off the top, whether it came to Ukraine and NATO, when it came to January 6th, and when it came to reproductive rights and abortion, he constantly tried to show how big the gap is between his vision and the former president's.
And I suppose the question is this: which of those translates down to those swing states, Anne-Marie? Because some of them are much more prescient issues in the swing states than others. The differential, which do you think cuts through, is a phrase that we use with the electorate?
Well, I think it's very early on right now. Libby Cantrell of PIMCO was on Surveillance earlier today, and she talked about the fact that it's really hard to digest what's going on in terms of policy, because at this point in normal American election cycle, we'd still be in the middle of a primary. But we've already had the general election cycle underway. And many would argue it's been underway since they last faced off against each other in 2020. So when it comes to these swing states voters, at the moment, Trump is leading Biden, according to our polling with Morning Consult, in all of these swing states. His biggest issue last night was going to be his age, given some of the damaging polling about the concern voters have about his age. In our swing state poll, 8 in 10 of these voters in these key battlegrounds say he is just too old to be elected. So Biden really wanted to show that he was up for the job. But the bar was very low going into it. When you look at some of the YouGov polling, only 16% expected him to come out like that. So he cleared that bar. The question is, can he maintain it?
Yep. Let's see. As you said, it's going to be a long, long campaign. It's a very different cycle that we're going to be in through this. Anne-Marie, thank you very much. Anne-Marie Hordern in Washington. Anastasia Amoroso, Michael Collins, I'm my guest this morning. Anastasia, good morning. You say we're already preparing in some format for a Republican basket. The question is the momentum of that Republican victory in terms of whether it's a clean sweep is going to drive this narrative. This is the outperformance of Morgan Stanley Republican basket relative to Democrat, relative to SPOOs. How much attention are people paying this far out to positioning?
I think people are starting to pay attention, and you sort of wouldn't know it from looking at the overall markets because those are moving on growth and Fed policy. But as those baskets show, hedge funds, for example, are certainly starting to position for certain outcomes. So if we look at, for example, flows going into some of those Republican outperformer baskets, the positions are definitely picking up. And so the longs are picking up there, the shorts are picking up on the Democratic side. And, you know, you could make the case that some of the Republican baskets are also going up because they have a high degree of cyclicality. So when you look under the hood, it's things like financials, it's things like industrials that really comprise the bulk of those outperformance baskets. But at the same time, I think people are starting to think what the next administration is going to look like, and they want to pregame that.
And that could be a Democrat administration as well, Michael. And either way, the deficit, $1.6 trillion of a deficit. If both candidates are talking potentially about enshrining the Trump cuts or more Trump cuts and Biden maintaining the Trump cuts, along with both spending programs, we could set up for 2025 as being a pretty big year of tussle in the bond market, couldn't we?
Yeah, absolutely. I think it's increasingly difficult, Manus, to figure out what the market reaction, what the economic reaction might be to whether you have, Trump or Biden in office for the next 4 years, because I think their policies, to a large extent, are starting to move together, right? You mentioned the fiscal side. I mean, I think in either case, we're going to be stuck with large, chunky fiscal deficits, a lot of supply. Maybe the rates continue to stay more elevated than I think they should be, and maybe that's the trade that's being priced in. But even on the toughness with China, even on focusing on domestic manufacturing, it seems like both candidates are kind of moving more into that same policy sphere. So it's really difficult to figure out. Like last time we had the big Trump bump, we called it, rates skyrocketed, inflation expectations jumped with Trump in office. And I don't know if you can really discern between them as much.
Okay, well, hopefully those nuances become clear. Anastasia Amoroso, Michael Collins, my guest this morning on Jobs Day. Time for your trading diary. This is what you need to watch out for next week. We have Biden proposing the U.S. budget to Congress on Monday. The numbers for February CPI, critically important on the back of the jobs report at 8:30 a.m. on Tuesday. VW Adidas report on Wednesday. Then it is U.S. PPI, retail sales, and another round of jobless claims next Thursday. The fissures in the employment landscape there. UMich sentiment comes out on Friday, rounding off the week. And that was Countdown to the Open. I'm out for a week. I'll leave you in the hands of Danny Berger next week on Bloomberg.